This is adjusting entries in 3 minutes. Adjusting journal entries are entries made in the general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded, and hence under the accrual basis. Adjusting entries does not take into account the cash account, as cash does not coincide with the earning of a revenue or incurrence of an expense. For example, cash can sometimes be received after a revenue is earned. There are 4 types of scenarios concerning adjusting entries: deferred revenue, accrued revenue, deferred expense, and accrued expense. In this screencast, we'll be talking about deferred revenue and accrued revenue. A deferred revenue is when a company receives cash before it provides a service. This is because at the time of the cash receipt, the company has not yet provided the service promised to the customer. The recording of the revenue must be postponed or deferred until the revenue has been earned. When adjusting journal entries, the company must record this transaction as not a revenue but a liability. To illustrate, suppose that a company receives cash prior to a service in 1 month. On the 1st of September, the company receives a total of $1,000 prior to the service. To record this transaction, the company will record the following entry. The entry initially increases the cash account by the amount received. However, because the company now has an obligation to this customer to fulfill the service, the liabilities account called unearned revenue increases. This will result in both assets and liabilities increasing. Suppose at the end of the month, the company provides a service and financial statements will be prepared. On the 30th of September, the adjusting journal entry should be made. This entry increases the services revenue account by the amount earned during the month and decreases the liabilities account unearned revenue by the same amount. An accrued revenue is when a company earns its revenue before it receives a cash payment. Accrued revenue is defined as the accumulation of money earned to a business which has not yet been paid for. When a company provides a service to a consumer and has not yet received cash payment, the account receivables asset account and service revenues account both increase, as this is money the consumer owed to the business and payment earned for the service provided respectively. To illustrate, on 1st of September, the company provides a service worth $2,000 but has not yet received cash payment. To record this transaction, the company will record the following entry. This entry increases the accounts receivables account and the service revenues account by the amount earned. As a result, both assets and equity increase. At the end of the month, where the customer provides cash payment to the business for the service, financial statements will be prepared. On the 30th of September, the adjusting journal entry should be made. The entry increases the cash account because the consumer provided payment to the business, and a decrease in accounts receivables by the same amount, as the amount of money earned by the business has been collected.